So let's begin our downtrend channel study. This is Microsoft, spanning 15 days on a 60-minute time frame. 60-minute time frame is very good for stocks. Anyhow, this downtrend channel has been picked. This study's been cherry-picked as it's not straightforward. Clearly contains valuable knowledge, but first and foremost, when we apply trend channels, we need to use logic. Now, if you can remember our support and resistance studies, when I was speaking about the anchor points, if they're too close together and there's like an imbalance, the same applies with channels. Like here, we have A and B, and then we come down to C. I'm not too comfortable with this channel. What I mean is, say we price comes back to here, I would not feel comfortable trading around this edge. So support A, so anchor point A, anchor point B, we come down to C like this. Then if we rally up, we don't come back down here or here. If we rally back up from C and we come to this area, it makes me feel very uncomfortable. I couldn't take a trade in this area. But we do come down here at D and we hold here. Slight violation, but we hold. So as we rally, now I feel comfortable. So if we do revisit this area, now I feel comfortable taking the trade. So in an ideal world, what we want to see is the white space. So we have A, B, C. That's a nice distance between, between here and here. There's a nice white space. Okay, these anchor points, as I previously said, they work together to hold the load. They share the weight of price. Whereas here at A and B, it's just too close together. And if you come down from C and we rally, it doesn't look, it doesn't feel stable. It's out of sync, it's out of proportion, it's visually unpleasing. If we look at here is a good way to think about it. Between A and B, we have this much distance, but the move down, so we rally, if the move down is 3 times the size of this distance traveled. So as you rally up, it just is. I can't explain it other way, rather than you need to practice, but you need to understand that it looks and feels heavy. Okay, we're not sharing the weight between the anchor points. This will topple over. Now this study's also been picked because it's the demand line that validates our channel from the holds here, here, and here. So then as we rally back up, we would draw this in, but now we have confidence to trade. So even though it's a downtrend channel, the demand line validates rather than the supply line. It's very interesting. So we hold at D, we rally, come back, we test, we hold, come back down, holds as support, come back down, acts as resistance. We get trading opportunities all along here. Why? Well, first of all, we've got structure to lean against, and we now know it's working. It's a validated channel. And then we come back down, we hold, we rally, we can't manage to get back to supply line, consequently we fall. Now, as we fall through, it's not, the price action isn't the best, but as we rally, it holds as resistance, which is unsurprising because it's been support and validated support the majority of its life. But what do we note about this move down? We can't break this level of support. We're trading sideways. We're unable to make lower prices, and then boom, draw this in. We've got this little local level here. Either or, this bar springs, and we trade back within our trading range. So although this spring, is screaming strength, it's a very hard trade to take. and we wouldn't want to. Why? Because we are trading outside, so this should act as resistance, and it's held there. Although this looks like strength, we can't take the trade because overhead is resistance. We don't know it's going to rally through, but we do note that this is a spring, which of course is a sign of strength in itself. So we rally back. Now we come back down and note this behavior here, a very subtle nuance. It's the price action in F. Why are we holding the F? The market is weak and we're breaking down. The sellers are in control. So why is all this price action holding? Don't forget, this is a 60-minute time frame. So this is a day's trading in a liquid stock, Microsoft. This is the largest cluster of price action we can see anywhere on the chart. And it's a very simple answer. It's because we're respecting demand once again. Now, isn't that fascinating? We are holding because we are trading back within our channel and it's acting as support. Amazing. And I'm sure the market gives you ample opportunities to jump on board, especially if you go to lower time frames. But this kind of behavior, we need to put our logic hats on. Just think deep about what's occurring down here, using structure. And okay, now what happens here? We break the highs, these local highs of our cluster, very important, and these highs in one solid move. That is strong demand. And from this break, what do we make? Highs, higher highs, low, higher lows. So we're in a minor uptrend. And don't forget, from our previous study, if we become slightly oversold, which we did here, and we start trading back within the channel and we hold, odds favour now a test of the supply line. Okay, odds favour that this will happen. So from this bar, we continue north and we can draw a trend channel. We break the supply line. So the supply line. And we get, it's not the cleanest break in the world. We want to see larger widespread bars, but we break nonetheless. We become overbought in the micro channel. We come down, we try to hold here, then boom, this bar slams down, reverses the closed firm back above support. So this is a shakeout bar. See, this bar wipes out weak longs. It induces a bear trap. Many millions of shares have been added to their inventory before markup. So right at the close, we have to buy this bar. Why? Because we can see, we can read and recognize the strength. Just think of the longs that this shakeout bar is eradicating. Buying, buying, buying. Come back down, we hold. People will note that. Clever traders would buy down here. Good demand. We come back down, we test this, buying. Okay, so that there's a lot of buyers and they want their contracts. Don't forget, this is a stock and has floating supply, which is different to futures. And look, isn't that fascinating? Where does this shakeout bar come down to? Where does it find support? At this level where it found support here and here. Isn't this amazing? Now, don't get me wrong. When this is coming down, we are not looking for a trade here. This is a very scary shaker bar. And if I'm long from here, or certainly long from here, we would take partial profits out of the supply line. But as this is coming down and breaks this low, I'm out. This scares me out. But the difference is when this reverses to close firm, I'm back in. Why? Because it's a shakeout. And a shakeout is strength. It's very bullish behavior. Although a very scary bar, it is bullish behavior. And this is why we take partial profits. If we're long from here or here or here, This is a supply line. We would expect price to react. We don't know it's going to break and then come out down and hold and shake out. We don't know that. But from the close, we have to take this bar. Not only that, we get 2 wide spread up bars after the shakeout. And this occurs quite frequently. Why? Because people are cautious. They're scared to enter, both buyers and sellers. This is a very scary bar. And we know that widespread bars often indicate professional activity. So all these wide spread bars indicate good quality buying or selling. Are there any further questions? How do you determine whether a overbought, oversold condition is a break at like E? Oh, yes. So E. Very good question. I think what you mean is, how do we determine whether it's a break or oversold? Okay, well, first of all, we know a valid break should be a nice widespread. Okay, but here we do get a slam down, granted, but for all intents and purposes, a nice big widespread is ideal, like we get here, this kind of action. But I don't like to use percentages, but I think Wyckoff used the 50% rule, or it's generally used in trading. So you measure, say, the highs, you just eyeball it to the lows is this distance, so that's half. So you don't want to see a violation of more than half of the trend channel. Then it's too deep. Then we would consider the violation too deep and a genuine break. Okay, it's a very good question. I mean, it does depend on the markets you trade, because they all have their different personalities, but the general rule of thumb is you do not want to see a break or a violation of greater than 50%. So just eyeball the supply line to the demand line. That's roughly half, and that is contained. Very good question. At E, the trend is also long in the tooth. Oh yes. Well spotted. Yeah. This is a 1, 2, 3, 4, 5, 6, 7, 8, 9. That's a 10-day trend on a 60-minute time frame. So that, yes, it's very long in this. Yes, it is an old trend. And if we have a look, momentum carries it down. This isn't one swift move, but we can see that this kind of action is different to all this selling we've had previously. Look, we slam down, hold, slam down, push up, hold, come down, push up, slam down, hold. Here we slam down, slight rally, then we come down again. So a little bit of momentum holds, enables this break, but well spotted. We are oversold in an established old trend. Excellent. I don't see any further questions. Let's move on to the next study.